Welcome to my channel today. This is King's Tutor. It's the first time of joining us. Thank you for liking this channel and ensure you like, comment, and share this video. Okay, let's reach other students. Now today we want to see hire purchase account. Okay, a hire purchase is one of the topic that's very important in accounting. Okay, now before we proceed to the calculation, we're going to solve. We're going to learn and know some concept as regards hire purchase. Okay, now what is hire purchase as per se? Now, the hire purchase is an aspect of a sale of goods that involves, or it's a contract that involves a hirer and a vendor. Okay, now it can be a buyer as per se, a buyer and a seller. Now, in this regard, now the buyer can be known as a hirer, while the seller can be called a vendor. Okay, so the hire purchase contract is a contract that exists between person we known as a hirer and a vendor, in which the hirer is allowed to use, or the buyer is allowed to use or take possession of an asset. Okay, to take possession and use an asset, but ownership still remain with the seller until the last installment is being made. Okay, so what this means is that a hire purchase refers to a contract between two persons, the hirer and the vendor, or we can call them the buyer and the seller, where the seller allows the buyer to make use of the asset. At first, an initial deposit must be made. Okay, so let's say, for instance, you have an individual that wants to buy an asset, but do not have the whole sum to pay for that asset, and he can get a hire purchase contract. Now, what he's trying to say is, okay, I have interest in this asset, but I do not have the full money to pay, so he will just have to make a deposit, in which then he has to make instrumental payment until he clears off all the amount that is aligned to that asset. Okay, so a hire purchase contract arises when a prospective buyer is allowed to take possession and use an asset pending when he makes full payment. That is when possession, ownership of that moves from the seller to the buyer. Now, an hire purchase is different from sale of goods act, in the sense that for sale of goods, the ownership and the possession moves immediately from the seller to the buyer. Why? Because full amount is being paid immediately. But for hire purchase, the full amount is not made immediately. Okay, the hirer just made a deposit to show that he has an interest, then a subsequent instrumental payment is being made. So possession of the goods moves from the seller to the buyer, but ownership is still retained by the seller. Why? Because that amount is not yet, the buyer has not yet paid for all the full amount of that asset. Okay, so that is what the hire purchase contract. Okay, now there are parties to this hire purchase contract, or aspect I would want us to know. Parties to this hire purchase contract, and the first party to this hire purchase contract is the buyer. The buyer, who is known as the hirer, and two, we can have the seller, which is known as the vendor, and the third one, we can have what we call the finance house. Now, I'm going to explain this. Now, the buyer, who is the buyer? And this is that individual that approaches another that he wants to make use or to get an asset. Okay, for instance, if we have, let me say we have two individuals and we have an asset. So this individual can be the buyer. He approaches this other person that he wants to make use of the asset. Okay, so this individual becomes the buyer, or the hirer. Okay, so why this other person, the vendor or the seller, refers to the person that owns the asset, that wants to sell the assets. Okay, either on hire purchase basis or on a normal sales basis. So the seller or the vendor is the owner of the asset, okay, that sells to the hirer. Why the last part of the parties to a contract is the finance house. Now, who is the finance house? The finance house is the act or stand as intermediary between the buyer and the seller. Okay. Now let's take for instance. Now, the finance house stands as an intermediary, like we said before, that's supposing the fact that the seller do not have to wait until the last payment of the installment. He will have to meet the finance house to get funds from them. Now let me give an illustration. For instance, if the buyer approaches the seller that he wants to get the asset, and let's say supposing the full price of that asset is, let's say, $200,000. Okay, and he approaches the seller and he doesn't have this amount as per $200,000. Okay, so he makes an initial deposit. Let's say he makes $100,000 as initial deposit. Now it's remaining 100,000. Now that 100,000 will have to be spread to be paid at instrumental basis. So when he start paying it, it might exceed this actual amount because this is the amount that he wants to sell outrightly, immediately. But since it is involving hire purchase, it might be more than this because interest will be attached to it. So if this buyer sends this 100,000 to the seller, okay, it means that it is still remaining $100,000 as per se. So, and the seller will have to get it on installment basis, okay? And this seller have an urgent need of money. He can't wait. So he takes the document to the finance house. Now, explain all this. The finance house act as intermediary. So the seller would have to explain that he's in need of money, that he has an asset that an hirer is in possession of, but he has not made full payment. So this amount can be given to the seller by this finance house, pending when this buyer starts making instrumental payments. So when this finance house gives the seller this amount, so the remaining balance and other instrumental payments will be made by the buyer to the finance house instead of what? The seller. Okay, so the finance house stands as a means whereby the seller can get funds since he cannot wait for the last installment payment, okay, for the buyer. So those are parties to hire purchase contract. That's the buyer, the seller, and the what? And the finance price. Okay, now let's see basically what we mean by the hire purchase price, or what comprises of the hire purchase price. Now, it's what we call the hire purchase price. Now, the hire purchase price comprises of what we call the cost price to the pure gross profit, and 3, the hire purchase interest. The cost price, the pure gross profit, and the hire purchase interest. Now, normally when you have a goods or an asset, definitely we have a cost price, the cost in which the asset was acquired. Okay, that is what we mean by what? The cost price. Now, this is the hire purchase price is comprised of these 3: the cost, the pure gross profit, and the hire purchase interest. I'm going to explain that. So the cost price and is the cost of the asset. Okay, while the pure gross profit is that gain that is being attached to that cost price when it will be what? Sold out. Okay, so normally for a sale that involves instant moving of ownership from the seller to the buyer, that's a normal sales of goods contract. The cost price and the pure gross profit is selling price, because we know cost plus profit is selling price. So the normal cost price plus gross profit is equal to selling price. Is equal to selling price. That is what the asset should be sold. That is when an individual is required to pay immediately and get the goods immediately. Okay, but when the individual do not have the full amount to pay immediately to get it, it means that he has to pay basic instrumental payment within a specified period of time. So that basic instrumental period within a specified period of time, there will be a penalty attached to it. Okay, that amount attached to it is what we call interest. So when you add the cost price plus the profit plus interest, it becomes or gives us the higher purchase price, the actual higher purchase price. So the difference between the selling price and the higher purchase price is this interest that was attached because the payment was not made immediately. The payment is made within a specified period of time in which instrumental amount is being paid at intervals. Okay, is what's that interest. Okay, so note that the cost price plus the gross profit is equal to the selling price. That's the cash selling price. Okay, and also note that the higher purchase price is equal to the cash selling price plus higher purchase interest. The cash selling price plus higher purchase interest. So higher purchase price is equal to the selling price plus what? The interest. I said that before. So the selling price is cost price plus gross profit. That's normal selling price. So to get the higher purchase price is different from normal selling price. I said it before because of the interest. Why? Because you're not making a payment immediately. Okay, so the higher purchase price is the selling price plus the higher purchase interest. Or another way we can get our higher purchase price, these are two ways, is equal to the deposit plus instrumental payment plus total installments. The deposit plus total installment. Now these are two ways you can get the higher purchase price. Okay, the first one is the cash selling price plus the interest. Right, the second one is the higher purchase price equals deposit, because an initial deposit must always be made. So when they know the cash selling price, they'll be required to know if you are paying immediately the full. If not, then they enter into a higher purchase contract. But an initial amount will be paid. That's the deposit. Then other subsequent amount is called instrumental payment. The total of it is once added to the deposit can give the higher purchase price. And this total installment is where the interest is embedded inside. Okay, where the interest is embedded inside. So these are the higher purchase price, the cost price, the gross profit, and the higher purchase interest. Whereby the higher purchase price is the selling price plus the interest, or the deposit plus what? The total installment. Okay, so let's see accounting for higher purchase transaction. Let's see accounting for higher purchase transaction. Okay, now accounting for higher purchase transaction can be done in two ways. Now, since it involves the active people involved in this contract is basically the buyer and the seller. So it will involve the buyer's book, to record in the buyer's book, and also the seller's book. That is, the person making that is the hirer will have to prepare his own book, while the seller also will prepare in his own in his own book. That's the seller's book. Okay, so now in the buyer's book now, that is our emphasis as well. We'll start now. The buyer's book. Now, what are the accounts that will be prepared in the buyer's book? That whenever you're given a question and they say prepare in the buyer's book, you have to know who is the buyer. The buyer is the hirer, the one that has possession, not ownership. Ownership is transferred when the full payment is being made. Okay, but he has to make possession of the asset. Okay, so the in the buyer's book now, once you're preparing in the buyer's book, now what are the accounts that should be needed? The first one is the asset account. Asset account. The second one is the vendor's account. The third one is the hire purchase interest account. The fourth one is the provision for depreciation. And the fifth one is the depreciation account. So these are the 5 accounts that is needed whenever you're preparing a buyer's book. Most times they might not require you to prepare everything. They might just give you specified ones to prepare. But when they are silent, you should ensure that you have all this. Okay. Now the first one, the asset account. Now the asset account will have to be recorded the yearly value of what the asset, since what brought the buyer and the seller together is because of the asset. Okay, so we have to take a track recording of the asset value from the inception of when the contract, when the hirer takes possession of the asset. Okay, so we have to prepare the asset account. Now, 2, the vendor is the seller, so the buyer will also have to prepare on behalf of the seller. He has to have a book prepared by him on behalf of the seller, which is the vendor. Okay, while the hire purchase interest account is where yearly interest, we're going to have if the contract will serve for 4 years, 5 years, as the case may be. So the yearly interest that is attached will be what's recorded in the hire purchase interest account, while the provision for depreciation. Now, the provision for depreciation will comprise of the yearly depreciation plus accumulated. Okay, while the depreciation account will comprise of only the yearly depreciation. Okay, so these are basically the 5 accounts that will be needed in the buyer's book. Okay, now let's see how to record the double entry principle that is involved in using the buyer's book. That is when we are preparing all this. What are we to debit and also what are we to credit? So we can see on how to prepare this. Okay, now when the buyer and the seller agrees to get into a contract, now the first thing they will have to know is what is the selling price of this asset. That's the first thing. And I said the selling price comprise of the cost plus the gross profit. So they'll have to know what is the selling price. So in knowing the selling price, now 2 accounts is being affected. Okay, now we have to debit the asset account, and we have to credit the vendor's account. I'll call it the hire purchase vendor's account. Now we do that with the cash selling price. Remember how to get a cash selling price. The cash selling price is the cost price of that plus the gross profit. Okay, we'll give you the selling price. Okay, so when they've known the selling price of that asset, you debit the asset account and credit the the hire purchase, the vendor's account. Okay, that's the first one. Now, if they've known the selling price now, it is now required that, okay, are we buying the asset immediately or want to enter into a hire purchase contract? Okay, that means we want to spread the cost over a number of years. Now, if they are spreading it, it means an initial deposit will have to be made before the contract will start to kick off. Okay, so once that deposit is being made, now we are going to debit the hire purchase vendor's account, and we have to credit bank because it is going out from bank, and this is for the deposit. With the deposit paid. Okay, so that is when the deposit is being paid. Now, when deposit is being paid, we have other money still remaining because you're not paying all. Okay, you're just making a part payment of the full amount. So when deposit is being paid, there are other payments that is going to be paid subsequently, instrumentally. And those other payments will be embedded in its interest. Okay, will be embedded in its interest. So we have to take track record of those interests. So when that amount is being made, so we have to open an interest account. So that interest account will be debited with the interest account, while the credit we have to go to the vendor's account, and that will be with the amount of accrued interest. With the amount of accrued interest. Now the next one, after you've made interest, now we have the instrumental payment. Actually, now will not be, we have to debit the hire purchase vendor's account, or just call it the vendor's account. I have to credit bank with instrumental payment. With instrumental payment, I said that before, because this interest is embedded into the instrumental payment. So we have to know how much was added as interest. Then for the instrumental payment, we have to credit the bank and debit the vendor's account since it's received by the seller. So the other one, we have to involve the asset. So now in the assets now, with the amount of accrued interest, instrumental payment. Okay, why for the depreciation now, for the yearly depreciation, so we have to debit depreciation account, now we have to credit provision for depreciation, and this is the reason with yearly depreciation. Okay, with yearly depreciation. Why the last one, now after we've recorded the debits, we debited the interest account. Now the money that's the interest that was paid, we'll call it the finance charge, will be transferred now to the debit side of the profit or loss account, while the corresponding credit entry will be at the interest account, and this is with the finance charge, that is the interest. With the finance charge, that's the interest. Okay, so this is basically the accounting entries that is required. Now we'll say the first one, when the asset when the car selling price is being known, and the car selling price involves the gross profits and the cost. When you add them together, you get the selling price. So the selling price, you have to debit the asset account and credit to what? The vendor's account. Okay, so when they've known the selling price, initial deposit will have to be made important. So when you do that, you deposit the account, pay the deposit. You debit the vendor's account since they're receiving it. You credit the bank account, and also with the amount of accrued interest, because I said other payments will have to be made and it have to be spread to the number of years. Embedded in those instrumental payments are interest. Okay, the interest is like a penalty for not paying immediately. Okay, so with the amount of accrued interest, you debit the interest account, you credit what? The vendor's account. So that instrumental payment that is being made now, you credit bank accounts, you debit vendor's account. Now for the assets, we have to what? Get the depreciation, so that at the end of the contract period, we have to know the actual value of the asset by what? By deducting depreciation. So we debit depreciation account and credit provision for depreciation with the yearly depreciation. Okay, why when you're done with the interest, your total amount of the interest is posted to the profit or loss account. It's debited there, while the credit entry is the interest account to close the interest account. So, and this is with the finance charge, or what we call the interest. Okay, so whenever you're required to solve a hire purchase account, the first thing you have to do is to calculate your interest. Yes, you have to calculate the interest so you know how much is being required to be paid instrumentally. Okay, so the calculation of interest is what is supposed to be done first before every posting. Okay, now let's know how to calculate this interest. Now we're going to see an example on how to do that. Now before we do that, if you have not subscribed to this video, ensure you subscribe to this channel, like, comment, and share this video. Okay, ensure you like this video. Now let's see a question on how to calculate this interest. Okay, before we see a full posting on how we can post to other parts of this account, the double entry, to see a typical question. But let's see on how to calculate interest first. Okay, welcome back. Let's see the question relating to the hire purchase. That's calculation of interest. How to calculate interest. Now the question said, on 1st April 2007, machinery is purchased on the hire purchase system. The payments to be made 10,000 down. Now, whenever you hear 10,000 down payment, it means deposit was made. Okay, that is on signing of the contract, or on signing of contract, payment was made, means there was deposit. Okay, and he said, and 10,000 naira annually for 3 years. That is, the instrumental payment is 10,000 for 3 years. Okay, now they said the cash price of the machinery is 34,860. Now watch, 34,860 is the cash price. Had it been that they have full amount of money, the full amount to pay, they will pay lesser. But because it is on because it's on hire purchase system, they are making 10,000 as down payment. That's 10,000. Then order 10,000 for 3 months. That is 10,000 for 3 years is 30,000 plus the initial deposit 10,000, that's 40,000. So they are paying higher in terms of hire purchase than they would have had it been they have the money for to get the machinery outrightly. Okay, so I said the cash price is this, and the rate of interest is 10% per annum. Let's calculate the interest. Okay, and this is the first thing you should do, or you should know how to do before you prepare hire purchase account. Okay, because you want to know the actual interest, how much was added at each time. So what do we do in this situation? Now, what to do is, this interest is on the remaining amount that was not paid. So that it will be added to the amount remaining. So the hirer will pay it as it's paying his instrumental amount. So we have to deduct, now, by first, we have to deduct the amount that was paid, initial deposit, from the cash price of the machinery outrightly. That's the cost of the machinery. We have to deduct it. That's the first thing you should do before you start applying the interest. So follow me squarely. So if we say cash price That solution, cash price of the machinery, which is 34,860. Now said less down payment or initial deposit of 10,000, and this will give us 24,860. Okay, now this is the amount that interest is supposed to be added on now, and they say the rate of interest is 10%, so it will be 10% on this amount. Okay, so we add interest on add interest on 24,860 at 10% for the first year. Now they say 10%. Now 10% on this will give us 2486. I think so. 2486. So when you add it together, you have 6. You have this is 4. This is 3. And this is 7. And this is 2. So this is the amount that is supposed to be paid. Okay. So less the first installment. Less first installment. Remember they said 10,000 and 10,000 annually for 3 years. So the first installment is 10,000. So less it 10,000. So we'll have, deducting this, we'll have 17,346. Okay. So again, we're going to calculate the interest. So we'll say add interest on this amount, 17,346 at 10% for the second year. So 10% on 17,346 using my calculator will give me 1735. So if I add it together, it will give me 19,081. Okay, so now say less the second installment amount, because they say 10,000 should be paid for 3 installments as 10,000. So we have 9081. Okay, now the third interest now will be interest. Now, you will not calculate on 10%. Now, why? If you calculate on 10%, the amount you get will exceed the last installment, 10,000. So what we're going to do is the amount that is necessary. So we're going to add, since we know that it is 10,000 that is supposed to be paid. They've paid the first installment, the second installment, then the third installment is 10,000. So we deduct this amount from 10,000. So if you deduct it from 10,000, the interest, the amount that will be here will be 919. So that when you add it together, you have 10,000. Okay, so we'll call it amount necessary. Not actually on the 10%, but the amount that serves as interest, so that when you add it together, it will give you 10,000. Okay, so less third installment now. The third installment is 10,000. So 10,000 minus 10,000 is 0, is dash. So with that now, you've calculated. So the interest for the first year is 2486. The interest for the second year is 1735. And the interest for the third year is 919. Now with that, we have calculated the interest for this. So we can now start posting to different accounts if we are required to do so. Okay, so that is how to prepare the interest. Now we are going to see another example as time goes on this. There are other examples that we are going to see on how to solve that, on how to post to the asset account, the vendor's account, to the interest account, to the provision with depreciation and the yearly depreciation. Okay, so ensure you have liked, comment. Please share this video to your department WhatsApp group and Facebook group so that we meet more students. Okay, and it will encourage us to know. Just drop your question in the comment section below. Thank you very much.